Hey, welcome everybody to the 40 Finance channel. My last video I did like a top 100 stocks to hold for the next 10 years. And one of the parameters of the screen that I used for that was growth rate. And by growth rate, it was EPS growth rate by at least 10%, but also revenue growth rate by at least 10% looking ahead. And it was interesting because this actually eliminated some pretty big names, and I got a few questions about, hey, what about this stock and that stock? Wouldn't those be good for 10-year holds? And in a lot of cases, I think they were. So in this video, going to highlight some companies that I think are great companies and likely solid 10-year holds, but at least on the surface with the information we know today, their growth rate for the next couple years is a little spotty, certainly in single-digit range. Now, one of the things to keep in mind is that revenue growth isn't always the end-all be-all for the performance of a stock. Obviously, when you run a business, there's a lot of interest in profits. So most of the best companies, they can grow their profit rate sometimes at a higher level than their revenue rate. And when you start picking off really big companies, say Apple or Microsoft, when you're making billions and billions and billions of dollars, it's really hard to achieve double-digit growth rates in revenue. But what you'll often find is their profits or their earnings per share will be growing at a very solid pace, and that starts to bring down the fundamental valuations as well. So there's more than one way for a stock to go up. Usually, though, you want to see at least some growth. Now, negative sales growth is a killer. And when you start to see earnings reports come out where you made, say, $100 last year at this time, and now you're down to $90, those types of earnings reports can bring sort of dark clouds and negative sentiment for a stock. But in the scope of a 10-year hold, it may not be that big of a deal if you believe that the company is on track to do great things. All right, so jumping in here, we're going to look at some solid companies, big companies, but the only catch is, and why they wouldn't have shown up on my screener in the last video, they're probably in single-digit growth rate percentages right now, which would have prevented them from being in the 100 video I just did a couple days ago. All right, for this video, I'm just going to use the Seeking Alpha stock screener because it was just a little bit easier to get to the numbers that I was looking for. This is sorted by market cap, and Seeking Alpha uses a grade card system. So we'll dig into the individual numbers of a stock here in just a minute. But what we're really looking for here is this column, which is growth. And we want to see sort of bad grades, if you will, right? So under a C minus into the D's and F's on growth. That gives us some idea of which companies are struggling to at least produce projections of growth in the future. So if you look across the board in Seeking Alpha's world, you can see that Apple has a D minus in value, a C minus in growth, but look at the A plus here in profitability. They're churning out profits. So this company is doing everything that a company aims to do, and that is make profits. But when it comes down to the actual revenue growth, here you see the EPS growth. And these are projections. So keep in mind, some of these projections will be just flat out wrong as time goes on. Say we wake up tomorrow and Apple bought Microsoft, right? Which isn't going to happen, but you know what I'm saying. We could wake up to new news tomorrow and these numbers could change. But right now, for Apple, September 2022, when that fiscal year ends, it's looking like a flat year. Both on the EPS side, 1% growth. And then if we go down to the revenue side for Apple, September 2022, and we have single digits, 3.27%. And as a matter of fact, 23, 24, and 25, at least today, are also holding a single digit projection for revenue growth. So that fact by itself just eliminated Apple from my previous video screener, which was looking for plus 10% revenue growth on both the top line and the bottom line. All right, next we have Microsoft, which is a notable miss from the last video. Again, value and growth sitting in the D's, but just like Apple, A plus on profitability. Let's take a look at the growth rates. On the EPS side, looks pretty good. You got double-digit EPS growth projected over the next, I don't know, several years here. And on the revenue side, you also have double-digit growth. So this is one, and I put that in the comments with Microsoft. I don't know how Microsoft didn't get put in the screener last time. It does fulfill at least all of the conditions that I see here. So if I went back and remade the top 100 stocks, I would say Microsoft should have qualified. Not sure why the name didn't show up. All right, I'm going to skip over Berkshire because it's really a holding company to some degree, so revenues and profits are going to be a little bit different in the way that we're looking at them here today. Visa's on this list. Now, they got a C minus in growth. Now, I think they qualified. Let's just take another look. EPS 15% and 24%, and then, oh yeah, growth is, double digits for the next couple years. Visa's obviously one of my top holdings. If they weren't on the list last time, it would probably be because this year, this projection of 10%, depending on what website you look at, it could range anywhere from 9% to say 11 or 12%. I can't remember if they were in the last video, but they certainly qualify for it as we're looking here today. All right, next one on the board, Johnson & Johnson. This has a growth score of F. So let's see how bad that turns out. We are on the EPS side of things. Solid growth this year, plus 20% on the EPS side, but then single digits from there. So that would likely eliminate them from the last screener list. This year you are in double digits, but then look at this, plus 3%, plus 3%, plus 3%. We'll see if those projections change. But what you're really thinking when you invest in a stock like Johnson & Johnson is, of course, you get a dividend with this one, and you have the fundamental EPS growing at least at some rate, right? So you see how the forward PE goes down over time. Essentially what you bought today, which is this earnings per share, goes up over time along with the dividend. And ultimately, with a company like J&J, you have limited downside on something like this. So you have probable upside. Maybe it's capped to some degree, but you have very limited downside for any of these companies we're talking about today because they're just so daggone big. All right, let's take a look at Walmart. Their growth score D, like everybody else on here, you got an A plus on profitability. We'll scan through their EPS, double-digit EPS growth this year. Then you're down into the singles. On the revenue side, this is why Walmart would not qualify. For the last video, you're in low single digits in terms of growth. But just like J&J, profits per share are still going to go up, and that will, of course, help with the general valuation of the stock price. All right, United Health Group, D minus. On the growth side, let's take a look. Year-over-year earnings per share growth, double digits for the next few years. And let's see, on the revenue side, you got double digits this year, but then single digits from here on out. They're inching towards double-digit gains. We'll have to see if the news changes and the projections for their sales go up over time. But they could get into double digits by the time some of these years roll around. But what's interesting about this company is the profits are growing at a faster pace than the revenue. So that provides plenty of shareholder value for those who are invested in this company. All right, let's take a look at Home Depot. Home Depot got a D- on the growth side. See what's going on in their world. 21% EPS growth for 2022. And then you got a couple years of single digits. See how revenue's looking here. Oh yeah, plus 10% this year, which is solid. Then you have 1.5%, 3.2%, and 7% for the out years. So Home Depot wouldn't qualify for having double-digit growth on the top and bottom lines. All right, just for fun, let's pick out a couple more that are Fs. Let's see, here's an F, Cisco Systems. You got an A+ in profitability, but an F in growth. Let's see what that looks like. Scrolling down to earnings per share, single-digit growth on earnings per share, but it is indeed growing. And then revenue projections, you know, single digits for what feels like the infinite future for Cisco. So this is one where, hey, you know, the price will likely continue to go up just at a muted pace. So you can see on their graph in 2020, EPS was $3.21. And in July of this year, they hit at 1 penny more. Next year looks a little bit better, but it is, to be fair, it's only 20 cents more. So you're not going to get a ton of drop in your forward PE at that level. But as you start to get into the out years, you do keep building on it. I would say Cisco, without any acquisitions or new news, I would say that this would be the type of stock, again, very low downside, but not a ton of upside here. Scrolling down, what's Coca-Cola up to? They got a C- in growth. And this one I just want to look at because Coca-Cola historically doesn't grow a ton. We can see perhaps they hit 15% growth in a COVID recovery year. Then on the EPS side, you know, they're hovering in double-digit range, assuming that the news improves. On the revenue side, though, you have this 14% this year. Don't forget, though, that is COVID recovery. I'm sure they lost some sales, particularly on an international basis. And then you see the 5% revenue growth. So don't forget, though, you do get a dividend with Coke, and Coca-Cola stock is on many people's list as a great forever hold. And I wouldn't necessarily disagree with that. I would just say that, you know, the next 2 years, I'm just not sure how much it's going to grow. And one of the things that you can do here with that statement is go check out the future, right? Let's assume they hit the 225 this year. So at the start in January sometime next year, the EPS estimate is 243. And let's just pretend that world holds true through January. That would put your forward PE at the beginning of the year at 22.25. Then from a historical perspective, we go look at what range their forward PE has been in. And for Coke, it looks about spot on in the 22s. You can make the argument that it's under what they have done here most recently, 25 and 24. But keep in mind, we're looking ahead to January of 2022 before that forward PE would take shape. And from that perspective, I would say Coca-Cola's valuation at $54.15 seems like it's about spot on, and I would not expect the price of the stock to move significantly over the next 6 months. All right, let's hit one more for fun. Let's look for an F. All right, Intel. So this is an interesting one. Just like some of the others, you got an F for growth, but you have an A+ for profitability, high margin company. Let's take a look at their earnings estimates. And here we have negative EPS projections anyway, negative EPS projections, not only for the end of this year, but into next year as well. Now, on the revenue side, you have negative for the next 2 years, but then you see this 2023 when you're potentially hitting 3.68% growth. That's where you have to understand the story with Intel, and that is that they are in sort of a reinvent phase right now, and they're trying to expand their production and capacity. These two blips on the radar, the minus 11%, hard to take those in consideration because they only have one analyst on it. So I would say with Intel, and I've mentioned on the channel before, I think you have time to get in this one and still take part in their recovery. But over the next 12 months, there's going to be a lot of doubters out there until people start to see their plans start the construction phase and stuff. That's when you'll start to see analysts change their tune a little bit, and maybe this EPS number and perhaps the sales number actually goes up on good news. All right, investors, so that's about 10 or so companies that have strong profits, right? They're doing what a business should do. They're creating shareholder value by printing profits. But what we see, and in most cases because they're so big, there is a struggle to grow their revenue base at a double-digit level. Now, like I said at the beginning, revenue growth is not everything. You can have a great stock that only grows 1%, 2% in revenue every year if they're bringing the profits on the bottom line. And in many cases, the companies we just looked at offer a dividend to their shareholders. So there's a lot to be said for the long-term holding value of all the companies that are on here today. All right, guys, let me know what you think of the stocks we talked about here today in the comments. As always, please give a like, subscribe to the channel, all the things. Thank you for your support. We'll see you on the next video.